Okay, welcome everybody to today's webinar on exiting legacy pensions and reserves in the self-managed superannuation funds. So this is a subject certainly near and dear to my heart. I know being around for as long as I have in the industry, I've had a fair bit to do with these legacy pensions, set up a lot of them, hundreds of them in the early 2000s. And some of those clients I still have contact with today. And so when we had this announcement basically from the government in September last year, when they released some draft regulations, it came as a bit of a surprise, primarily because we'd been hoping and waiting for it for some time, but it sort of jumped out of the blue and was of course linked largely to Division 296. Now, without going through what then happened with Div 296, we saw some progress on this, and I was involved with a core group of industry peers and Treasury in the conversation around these regs, and it was actually quite pleasurable. It's an odd word to use when dealing with Treasury, but it was good working with Treasury in regards to these measures, because they were very open to our knowledge and our history with regards to these items. And whilst we asked for a number of other sort of considerations, we're relatively happy with where the regulations landed. So let's jump into it, because there's a lot to get through, and what I want to make sure is that I give all the key areas ample time for us to focus on today. So we will be spending a bit of time about what the regulations actually do provide for. I'll go through an example of commuting a market-linked pension, and also the way that reserves and defined benefit pensions actually work and go hand in hand, because market-linked pensions are a pretty simple concept because they are ultimately account-based pensions, but our defined benefit pensions, which are our complying lifetime pensions, they are quite different from a structural point of view, and they're quite different from the way that people record them within the various accounting softwares. So I want to make sure that people are understanding of what's possible in this place. So one of the things I will say is that since these regulations came in December, I certainly have been relatively busy in reference to how many of these actually are in existence, and I've probably done now upward of 40 to 50 commutation files or documents for various clients around the country. So I've certainly seen my share of alternate scenarios and different structures of the way these things exist. So I feel that I'm in a good spot to be able to chat to you about it all today. So I guess the first thing, just to as a summary comment, is prior to the introduction of these regulations, there were very limited circumstances for us to be able to commute what these legacy pensions are, so these defined benefit pensions and market-linked pensions. And those commutations were ultimately to enable for the purchase of a new one. So you could commute a lifetime pension and start a market-linked pension. You could commute a market-linked pension and start another market-linked pension. And in certain circumstances, with changes to the transfer balance cap rules, you could also commute excess market-linked pensions, or market-linked pensions that exceeded the transfer balance cap, that were commenced as a result of a rollover of a pre-1 July 17 market-linked pension. So there was very limited circumstances where we could actually commute these pensions previously, and so to then get these measures and open up the opportunities that they've opened up for us was quite significant from an industry point of view. So I think it's worthwhile just taking a couple of moments to work through what these clients actually look like with regards to structurally how they got to this position. And they fit ultimately into two camps of client. You have clients who were over and above their pension reasonable benefit limit back pre-2007. So we had a lump sum reasonable benefit limit and a pension reasonable benefit limit, and that was effectively the amount of money that you could take tax concessionally from super, well before transfer balance caps and other things, the amount that you could concessionally take from super in the form of a flexible allocated pension back in the day. And that was all measured against the lower lump sum reasonable benefit limit. But if you wanted to target the higher pension reasonable benefit limit, then you had to comply with certain restrictions. One of those restrictions being that the pension was fixed and could only be indexed in accordance with a fixed percentage each year, or CPI. You could also not take lump sums, so they were non-commutable in that sense. So there was a lot of restrictions around those pensions to qualify you for the higher tax concession. And so those with larger balances tended to set them up for reasonable benefit limit purposes. On the flip side, these pensions were also exempt from the asset test requirements of Social Security. So they provided effectively a mechanism where lots of clients could put money into a legacy pension, defined benefit pension in the very early days, and that money would not count from an asset test point of view. And equally, the income, whilst counted and whilst tested, was subject to the old deductible amount rules. And so you would often find, from a purchase price point of view, that the assets weren't counted and a lot of the income was also excluded from being counted. So they provided a great avenue for people to be able to access age pension benefits. So significant. And for a lot of people, the reason they still have these pensions is because of that existing asset test exemption that came along with them. Now, of course, since 2000, these have been effectively banned from self-managed funds from the 1st of January 2006. Either of these old school pensions from a defined benefit pension point of view and their market-linked pensions have been unable to be commenced in a new sense since 2007. So they are legacy in the sense that it's almost 20 years now since people have been able to set these sorts of items up afresh. And the ongoing concern has always been that people locked in were restricted from a lot of the other new requirements and the new rules available to SMSF and broader superannuation members. And so it always was felt that something needed to be done with regards to giving some form of amnesty period to allow people to wind these up. And a number of years ago, the government did announce some changes, which when those changes were announced, they said, there'd be a likely taxing point on the winding up of these sorts of pensions. Thankfully, the regulations that we got introduced in September last year did not reintroduce that concept around taxing. And whilst we still have a time frame around the whole commutation requirement, the rules are very flexible with what we can do from an SMSF point of view. So let's look at these sorts of these regs and how they're going to impact our clients. So it's a 5-year amnesty. So let me jump back one step. There's two parts to the regulations. There is the ability to commute these pensions, and then there is the concept of making allocations from a reserve, and that is because reserves are linked implicitly to these pensions. But those reserve regs are broader than that, and I'll go through them in the second part of the webinar today. But the first thing, it's a 5-year amnesty. So 7 December 2024 is our start date, and 6th of December 2029 is your end date. So if clients have not commuted these pensions by that date, right, then they will revert to the old rules and become non-commutable. Now, I say that knowing that that is still 4.5 years away, and we don't know what happens to the existing amnesty in that time frame. But assume that the whole purpose of this is that the government want these things wound up sooner rather than later, and so they're giving quite a long window for people to contemplate. And when I say quite a long window, what you've also got to recognise here is that the vast majority of these pension recipients, particularly your lifetime pension recipients, are well into their 80s. And so the whole concept around managing a self-managed superannuation fund is often quite problematic for those clients. So there is often a desire to actually want to get out of these products, but they haven't been able to in the past. So 5-year amnesty commencing on the 7th of December. The regulations were tabled in February. They are in force, but they have not gone all the way through their disallowance period. So there's a concept because regulations aren't like law, which have to go through both houses of parliaments. Regulations can be introduced at any stage, but then they go through effectively a period of disallowance. So it's 15 days from the time that they're introduced, and it's 15 sitting days from when they're introduced, that a member of parliament can actually put a motion to disallow the regulations for whatever particular purposes. Now, the 15 days starts from when the regulations are first tabled, which was the 4th of Feb. We, of course, then subsequently had a federal election. So we don't currently have sitting days at the moment. So we are, in effect, 9, maybe 10 days into the sitting day period. And Parliament is resuming on the 22nd of July. That's the proposed recommencement date. And so when you add the necessary days, when you look at the sitting calendar, the likelihood of these regulations being locked in permanently will come to fruition at the end of July. The good news is that people have been able to act on these since the day they were tabled. So from the 7th of December, people can act on it without any problems. So it is a really positive measure for anybody that wants to look at getting out of these legacy pensions. So what we need to understand is what it applies to, what type of pensions it applies to, and then how that's actually going to impact the self-managed superannuation fund. So market-linked pensions are exclusively linked to Part 1 of the regulations, which is the commutation piece, all right, because they are account-based pensions. So we only have to look at Part 1 of the regulations, which is quite simple. When we start to talk about lifetime pensions and when we look at life expectancy pensions, then we have to link those up with Part 2 of the regulations around the use of reserves as well. But the key issue is this is a commutation in full. So if people are wanting to make the decision to commute one of these pensions, they must commute the pension in full, so in its entirety, including any reserve that's linked to that pension. I'm going to touch on that because the reserve bit is where the complexity comes in with regards to how these pensions operate. Now, when you commute in full, what happens next is ultimately subject to the decision of the member in conjunction with the trustee. So there are different rules if you are already in the receipt of a reversionary pension. I'll touch on that shortly, but generally the individual can either commence an account-based pension if they have transfer balance cap space, they can leave the money in accumulation, or they can take the money out of the superannuation system. So they've got effectively all options available to them. And because there's going to be a transfer balance debit attached to it, then most people will have some form of transfer balance cap space to be able to commence an account-based pension. I say some because there will be circumstances with market-linked pensions where a certain formula is utilised to determine the debit value, and subject to how much people have drawn down historically, that might actually limit the debit value itself. But we'll talk about that soon. So commutation in full, account-based pension, lump sum, withdrawal, or leave money in accumulation, or a combination of those three. The other thing is that it is going to have Centrelink implications. So when we look at that, what we need to understand is that the government have indicated their desire for people to unwind these pensions. Of course, unwinding that means changing the rules around their eligibility for such things as asset test exemption. And it means that if people make the decision to commute the pension, then they will lose their asset test exemption. Now, the issue with losing asset test exemption is if you do the commutation, then under Social Security law, by losing that asset test exemption, the Secretary of Social Security has the capacity to say, right, well, this fund or this individual was never entitled to asset test exemption, and they can go back 5 years and reassess an individual to determine if they're required to pay back any Centrelink benefits. Now, the purpose of this commutation authority, or the purpose of these regulations, is to ensure that nobody gets a Centrelink debt out of commuting these pensions. But to get that, we need to have a waiver of debt for Social Security purposes. Now, that waiver was introduced on the 26th of March. So we do have that, and the Secretary of Social Security will have the power to waive any debt subject to commuting an asset test exempt pension. However, unlike the regulations from a SIS commutation point of view, the Social Security regulations don't come into effect until the disallowance period, the 15-day period, is complete. Now, this is the current proposed Parliament sitting calendar. And so, as I said, it looks like it's going to go back on the 22nd of July, which means that these Social Security regulations, or this specification, will not come into effect until most likely early September, right, subject to nobody putting any disallowance in, which means that the Secretary cannot waive any debt until after that point in time. However, the way that the specifications are written, it says they can backdate it. So they can backdate all the way to 7th of December and waive any debt that would be raised. So really what we're saying with asset test exempt pensions is it will be a positive outcome for everybody. People will be able to commute their asset test exempt pensions. However, from a safety point of view, unless there's an urgent reason because of the health of the client or something, and they want to actually unwind it to allocate the reserves out of the pension interest, it's often better to potentially just hold fire on commuting market or asset test exempt pensions to this point in time. So, there is still some things to play out with regards to it, but at least we've seen the waiver, and there's no expectation of anybody actually putting any motion to disallow. And so in that respect, we should expect to see the waiver just flow through and a bit more activity in the new financial year when it comes to commuting asset test exempt pensions. So what we've tried to do in this area, in addition to providing support from a documentation point of view, and I'll touch on that briefly at the end of the webinar, is really sort of try to highlight some of the key messages around the decision to commute and whether or not it's critical for clients to go down that path. And so whilst these sorts of questions are worth contemplating with clients, because again, it's an advice piece. If we're talking about stopping an income stream, that's an advice piece. If we're talking about starting an account-based pension, that's an advice piece there as well. So we have to understand that whilst we can implement processes if clients come to us and ask us to do something, if we're not able to provide the advice whether they should or shouldn't, then we need to refer them to the appropriate places or the appropriate channels. So one of the things that they need to contemplate is access to capital. So how important is access to capital? Because that has been one of the driving things in all the discussions I've had with people over the last 20 years is, we can't change how much income we're drawing. We can't get access to lump sums like we can in an account-based pension. All we did was follow the rules as they were at the time, and now we're restricted to doing it. So that access to capital has been an ongoing consideration for a lot of people. And so, appreciating that with these new regulations, people are going to be able to get full access to the capital. The other one is, what is the impact of any loss of asset test exemption? Now, given again that most of these products are now into their 21st or 22nd year, the assets supporting that pension have diminished. Now, of course, there are some fairly significant ones because of RBL reasons, but the asset test exempt streams have often diminished to a point where the current fund balance is actually below the asset test thresholds anyhow, and so there's going to be little or no impact from a Social Security benefit point of view. But that's an assessment that people have to make. How accepting are they of losing that asset test exemption versus do they understand what happens when they pass away and this money then is ultimately sitting in a reserve, what the consequences are from an allocation point of view. And I'll touch on what those consequences are. And to be fair, the consequences aren't dire. It's just you need to understand that there's a different process when the pension member has actually passed away. How much income are they drawing down for those that are on a market-linked pension specifically, but also some of the larger lifetime pensions? If they're paying more than $125,000 a year from an income stream point of view, then they're paying tax on marginal tax on 50% of the income above that $125,000 cap. Now, with market-linked pensions, as the term diminishes, the factors get smaller, and the need to draw down more money becomes relevant, and therefore a lot more clients would be at that stage where they're having to draw amounts in excess of that that defined benefit income cap of 125. So then it's a matter of weighing up, okay, right now we get exempt current pension income on the assets supporting that larger pension, but we then pay marginal tax on some of the benefit we're drawing down. Is the loss of ECPI on the full amount, is that worthwhile to save tax on the drawdown component, right? So there's a bit of a tax balancing conversation to have. And for some people, that ECPI deduction is significant, and they don't have that much of a liability because they're not earning a lot more than the $125,000. So, some key things to consider. From a transfer balance cap point of view, again, the ability to actually put money back into another pension, another income stream, is going to come down to things like the debit value, particularly of the market-linked pension. For the lifetime pensions, it's very simple because the debit equals the credit. But for market-linked pensions, there is a formula that effectively takes into consideration all the drawdowns since 2017. So it means that the debit may be a lot smaller, resulting in less transfer balance cap space available. So there's some key issues there. And then just from a broader practical sense, what are you doing with the fund investments? Is there an opportunity to say, right, well, we want to commute these pensions, we want to get out of them, and we're going to move to a less internally tax-friendly environment for the super fund, so we'll be entitled to less ECPI as such. So should we be looking to reset assets from a CGT point of view, or liquidate assets from the fund now, whilst we have a higher exempt current pension income? And one of the overriding considerations here, I go back to the point that a lot of these clients are in their 80s or in fact in their 90s, and they are at the end of their life cycle with regards to how much longevity there's going to be within the SMSF environment. And so liquidity is certainly going to be a consideration for paying down benefits. So we have to take all of that into consideration. We also then have to look at the practical side of things and say, well, does the deed provide for the commutation of these legacy pensions? Now, it's an interesting piece, the trust deed area, and I'm not going to drill too deeply on it, but for those that remember back to 2004, 2005, when they actually put an end to paying legacy pensions or paying lifetime and life expectancy pensions in self-managed super funds, and they restricted these pensions to funds with more than 50 members. When those restrictions came in, trust deeds had to provide for the capacity to pay and to continue to pay these forms of pensions. So how advanced were the commutation clauses within those deeds back from 2000, pre-2005, because I've seen some that they're actually quite well worded that will say the pension can be commuted in accordance with any legislative requirements or whatever. So some others will say there's no capacity to commute, and then highlight what the actual legislation said versus a reference to the legislation. So the deed is going to be an important factor to determining whether or not benefits can be paid out. But in the 40 to 50 that I've done, I've seen a lot of flexibility within the deeds. Of course, other considerations: do you have market-linked pension? Do you have a lifetime pension? Or did the client previously have a life expectancy pension? Now, I say previously because in my experiences and for those that I was involved with in the early days, most life expectancy pensions, were set up for between 15 to 20 years. They were all set up before 2005, and so therefore they're at, if not already past their expiration of their term, they're at the end of their term now. And so these pensions would be effectively sitting there as just a reserve inside the fund. So we need to know how to deal with that situation. Importantly, is the pension being paid to the primary or a reversionary beneficiary? Because if the benefit is being paid to a reversionary beneficiary, then it's already met the cashing condition of the death of the member. So what that means is you have to sort of take a step back when you look at what the choices are following the commutation to say, well, we can't roll this money back into accumulation, right? So this money cannot go back into accumulation because it is a death benefit. So the money must come out of the superannuation environment, or it must immediately go towards the commencement of a death benefit income stream. So I've seen a few scenarios where the new account-based pension that is a death benefit income stream has been commenced with the commutation value of the amount coming out of the pension. All right, so let's have a look at how it works, because that sort of brings a bit more sort of sense to the whole sort of transaction, and what it might look like from a client point of view. So if we look at market-linked pensions first, the first thing that we have to understand is market-linked pensions are classified as one of two things. They are either cap-defined benefit income streams, which are those market-linked pensions that were commenced before 2017, before 1 July 2017, and have not been commuted since that date. So they are cap-defined benefit income streams. And then we have those that are considered account-based pensions for transfer balance cap purposes, which are those that have a post 1 July 2017 commencement date. So they are the result of the commutation of some form of pre-2017 legacy pension. With these cap-defined benefit income streams, they're the ones that I said before that are subject to this defined benefit cap, the $125,000, which means that the income over and above the cap, 50% of that income is taxed at marginal tax rate. So it doesn't have contemplation of tax-free and taxable components. That's all assumed to be in the first $125,000. Everything over and above that 125 is then 50% at marginal tax rate. So that's a key consideration for the cap-defined benefit income stream. And then when we commute the cap-defined benefit income stream, you've got this different formula that I'll go through in our example here to work out what the commutable value actually is. Not what the commutable value is, sorry, the reportable value for transfer balance cap, because the commutable value is easy. It's the entire balance sitting in the market-linked pension. So if we look at Judy as an example, Judy's 86, receiving a market-linked pension, had $600,000 with a 25% tax-free percentage. So all the standard stuff that you would see inside the fund from a tax-free, taxable component sitting inside the pension interest. Doesn't receive any age pension, so asset test exemption is not a consideration for Judy. She's got her, she draws down her pension monthly, and that's important because what we've got to recognise is we still have to satisfy all of the existing legislative requirements. So if we commute the pension, then we have a pro rata pension requirement to take before that commutation is undertaken. So in Judy's case, she's looking at whether or not she should commute the pension. So her transfer balance account looks a little bit like this. So her original credit in the transfer balance account was $1,038,840. Why? Because the income in the 17-18 year was $94,440, and that was multiplied by the term remaining, right? So that's how the credit value for cap-defined benefit income streams that were market-linked pensions was determined at the 1st of July 2017. Now, the reality is she might not have had that amount of money in the actual account itself, or she might have had more than that in the account. We have to apply that formula. So at the time, Judy also then commenced an account-based pension for the balance up to her transfer balance cap of $1.6 million. So she had an account-based pension of $561,000. Her total payments from the 1st of July 2017 up until the 30th of June 2024 was $600,000 roughly. So again, there is a record keeping requirement where you need to go back to view how much has been taken out to get the correct debit value. And then the account-based pension of the market-linked pension at 30 June was $600,000, and so therefore that's going to lead to a calculation of minimum maximum pension obligation, or minimum maximum pension obligation for the 24-25 year. And I say minimum and maximum because you have your statutory amount, and then you have your 10% variance. 10% lower is your minimum, 10% higher is your maximum, and your range is somewhere in between there. So what we have to do from Judy's point of view is we have to go, okay, well, what is her debit value from a commutation point of view? How much space are we going to be able to create inside her transfer balance cap to determine whether we start another account-based pension or leave the money in accumulation or take the money out of super? So we apply this formula, and that is the original transfer balance credit less the amount of any transfer balance debits that have arisen in respect of that pension. Now, in most circumstances, and in fact in every circumstance I've seen, that second part of the formula results in a zero number there. So we've got the original transfer balance, subtract zero, subtract the total amount of super income stream benefits the pensioner was entitled to receive before the start of the current year. So that's the $600,000 that Judy has drawn from the 1st of July 17 to the 30th of June 2024. And then we subtract the greater of the income stream benefits the pension has received in the current year and the minimum amount required to be paid under the regulation. So that's the pro rata amount up to the date of commutation, right? So we know that we've got the pro rata commutation requirement for the financial year. If we haven't drawn our minimum yet, then that's the amount that we're going to have to include in this formula. If we've drawn more than the minimum amount, then that's the amount that we're going to have to include in this formula. So let's have a look at how that would work from a calculation point of view. So Judy, in this situation, you know, we've got a date of birth, her details there when the pension commenced, her proposed commutation date. So Judy was looking at commuting this pension on the 31st of March 2025. There's 4 years remaining, right? So that's all relevant in determining what the pension factor is. You'll see there 3.67, I think that is, if I get close enough with my glasses on, means her statutory pension requirement for the year is 163,000. The minimum's 147, and the maximum is 180,000 in round numbers there. Her days in the commutation period from 1 July through to 31 March is 274, meaning her pro rata minimum is 110,571. So if Judy hasn't drawn that 110 out yet, that is the amount that, one, she needs to draw, and two, that will be used to add up onto the other amounts to determine what her transfer balance debit is. So when we then feed that down, we look at the original transfer balance credit of just over $1 million. We subtract the amounts that have been taken every year, and you can see them at the bottom of the calculator there. The greater amount of this year, which is the pro rata minimum, meaning Judy will have a transfer balance debit of $328,000 against her transfer balance account. So when we look at that from a formula point of view, we'll see that we had that original credit of $1 million, the account-based pension of 561. We've now got a debit of 328 representing the commutation, but it's not the full value because we know her balance was $600,000. She's not getting the full value. For those pensions started after the 1st of July 2017, she will get the full value of the commutation. But this means that Judy can only commence an account-based pension for the balance, which is 328, so the commutable amount, because that'll take her back up to her personal transfer balance cap of 1.6 million. And the rest of her balance will need to be left in accumulation or taken out of the super system. So that's how it works from a market-linked pension point of view. So the concept is relatively easy. Pick a date. If people are going to commute, pick a date that they're going to commute. Make sure they've drawn their minimum pension. Getting a lot of requests for people saying we're going to commute on the 30th of June. Perfect. You know what your annual income requirements are going to be, and then you can do the rollover after that date. But if you're picking a different date, you get the valuation, you do your calculations, you work out what your reporting obligations are, and then you move forward from there. So market-linked pensions, other than the complexity around the debit value for the cap defined benefit income stream, other than that, it's a relatively straightforward position that you're in. So let's now have a look at the defined benefit pensions and work through what the issues are associated with defined benefit pensions, because these pensions are 106.2 lifetime pensions and 106.7 life expectancy pensions, right? And as I said before, there's very few of those that are still remaining or still active as far as within their existing term, right? And what that really means is that those pensions are somehow being recorded as ceased within the accounting software of the fund, right? You assume they are, and somehow being recorded within the member statements of the fund. And I'm going to talk about that in a moment. Something to be mindful of is there is one other type of defined benefit pension that existed, or that does exist and exists in a number of self-managed superannuation funds. And these are what are commonly referred to as flexi pensions, payable under SIS regulation 1066. These flexi pensions are not subject to these commutation regulations, right? And the reason is because they have always been commutable. So 1066 pensions have always been commutable. The problem is the commutation value was always quite terrible because it was linked back to a SIS factor, which was effectively set in stone under the old RBL rules. And so you would, in many instances, find that if you commuted these flexi pensions, then you ultimately just end up with a reserve sitting inside the fund. But I'm going to come back to that because that's pretty critical in part 2 of the regs around the reserve allocations. But the ability to commute is only in place for 106.2 lifetime and 106.7 life expectancy. And the reality is it really is primarily applicable to 106.2 lifetime pensions. What we then need to work out is, well, other than the asset test exempt consideration, so, you know, are we going to lose our 100% asset test exemption? How much is this pension actually worth, right? Because a market-linked pension is account-based, so it's easy to determine what the valuation is. What is the actual value of the money supporting this lifetime pension? So do we need to get the actuaries involved in determining what the valuation is? Because each year, year in, year out, the actuaries have done calculations to determine what they call the best estimate liability, the mortality reserve, the investment reserve, and then surplus reserve money to determine that there is a high probability that these pensions can continue to be paid. So whilst it may be reported or recorded as sitting inside a member account balance, for actuarial and tax purposes, that money does not belong to the member. And I'm going to talk about that again in a moment. So what we need to appreciate is we've got 3 major players in the software space when it comes to self-managed industry, right? We've got BGL and Class and Supermate. Now, Supermate started later, obviously, from a product point of view than BGL and Class. So the majority of these pensions are sitting within both BGL and Class. So what we need to understand is, how are these pensions being recorded? Like, is there an active lifetime pension in place? How's that recorded inside the system? Is there an inactive lifetime pension? So the member has passed away, so it's kind of sitting there in limbo conceptually in a reserve situation. Do we have an active term? Do we have an inactive term? Do we have a flexi pension? And how is it all recorded? Well, this slide looks like a little bit of a dog's breakfast. I appreciate that. But what I've tried to do here is I've tried to show you what member statements look like across Supermate, BGL and Class. So left to right is Supermate, BGL in the middle, and Class on the right-hand side there. What you'll recognise, if you look at Supermate, they don't actually represent any balance in the member's account. So the member exists, right? They don't recognise any member or any balance in the member's account, but in the financial statements, right, they will show that the money is sitting within a reserve as a not yet allocated amount. And so the Supermate system, because it came into existence after the tax office position was driven home, which I'll go through in a moment, created the accounting process where the money sits in a reserve. Each year, the pension liability is allocated to the member and then paid out of the member. So you effectively start with nil balance in the member's account, and end with nil balance, and you just make an allocation in and a payment out from that reserve account. BGL and Class, because they've both been around since basically these pensions were in force and payable in the early sort of 2000s time, many of them are reported still sitting inside the member's interest. So they'll look like a normal member account. Now there's a communication piece here that has to happen with clients to let them know that that money doesn't technically at the moment belong to them. It belongs to the reserve, right, for the fund to use as it chooses. It just currently chooses to use that reserve to pay the lifetime pension to the member, but it's all sitting within that that particular account. And so when we look at these numbers as such, you know, it's representative of how the systems have allocated the money, but it might not necessarily be representative of how the actuary determines how much represents each member's individual interest. So that takes us to part two. Before we work out what a defined benefit commutation looks like, it takes us to part two of the regulations, because what part two does is provides us the ability to make allocations from a reserve. So in essence, part one is saying we can stop the lifetime pension, right? What we then have is a reserve, right? So we stop the pension because we've got the power to commute. The money is just sitting there in a reserve. And this goes all the way back to 2015. Actually goes well back further than that. But the ATO's final position on this was released in 2015 and reiterated when they did their reserves regulatory bulletin in 2018 or 2020, whichever year that was. But basically what they highlighted in this ATO ID 15/22 is that if there is separate ways of reporting, so either through a reserve or through a member balance or through both, then those amounts together represent a fund reserve, right? So it doesn't matter how you report these things, the tax officer's position is that that money is a reserve for use by the superannuation fund. So these reserve allocation regulations become critical because part one lets us stop the pension. So it stops the fund's liability to pay a pension, but then the money sits in reserve. And part two gives us the capacity to make an allocation from those reserves to the member, and importantly, make the allocation cap free, right? So the way that we know the reserves operate up until the 7th of December 2024 was if you had a reserve, and you could have had reserves for all sorts of reasons, but one of the reasons might have been the death of a defined benefit pension member. If you wanted to allocate that amount out to the clients, you had to allocate, you could either do it as less than 5% of their account balance to all members of the fund, and then there would be no cap. Otherwise, any allocation would be counted towards a concessional cap. From the 7th of December, it's no longer measured against the concessional cap, right? So we still have the fair and reasonable allocation requirement, but it's now measured against the non-concessional cap unless it is what is considered to be a cap-free reserve allocation. And cap-free reserve allocations sit in two very distinct buckets. Either it is less than 5% on a fair and reasonable basis to all members, right, which is the old standard concessional allocation rule, or it is being paid out of a pension reserve. Now, I said before that I'd come back and talk about the flexi pensions. A pension reserve is, you know, a reserve of a super plan, and I'm going to read out the definition here. You know, I don't usually do that sort of stuff, but it's a reserve of a compliant super plan at a particular time if the reserve is used at that time solely for the purpose, the pension liability purpose, of enabling the plan to discharge all or part of its pension liabilities as soon as they become due. So basically, any reserve that was set up specifically to pay the pension, so created because we had a defined benefit pension, will be defined as a pension reserve, and therefore any allocation from that reserve to the pension recipient will be cap free, right? And that's significant because what that means is we can use these regulations to allocate former fixed term pensions that have ceased, existing flexi pensions that have restrictive commutation rules, and lifetime pensions that now can be commuted in full. And any allocation to that pensioner will be 100% cap free. All right. Now that's if the pensioner is still alive. So let's look at the example. In this example, we've got Malcolm. Malcolm's 88 and has a lifetime pension provided by a self-managed superannuation fund. Current value of the reserve supporting the pension is $1.5 million, right? Malcolm doesn't want to continue to receive this pension. Part of the fund, it's not getting 100% exempt current pension income, but also from a declining health point of view and other things, he wants to be able to get access to the capital and pull the money out of super. So he has the capacity now under these new regulations to commute the pension. Like with market-linked pensions, some of these lifetime pensions also have a pro rata requirement. Now, they're a bit odd in that they have payment year versus financial year, so you might have different anniversary dates because these pensions are always based on the day they started, not on 1 July. And so you've got a pension liability that exists, but it only exists for those pensions that commenced after the 1st of October 2003. So a significant proportion of these pensions started before that time. Therefore, if they haven't met the minimum pension for the year, there's no reason to do so. Okay, so it's only those pensions after October 03 that are lifetime pensions that have to meet their pension obligation. But Malcolm can commute this in full, and then what he gets is he gets a debit in his transfer balance cap to the value of the credit in his transfer balance cap account, or transfer balance account, which means he actually gets a full debit of that $2 million that was originally reported, which means he's now got available cap space of $1.6 million, which means from Malcolm's point of view, he can put all of it, because he had just under 1.6 in his fund, he can put all of it into an account-based pension and get 100% exempt current pension income. So in certain circumstances, particularly around lifetime pensions, where the value has dropped below that 1.6, clients are actually going to be able to benefit from getting higher ECPI and still moving into the more flexible account-based pension type arrangement. Now, this whole concept of allocation, and I mentioned actuarial certificates before, if you've got a single member fund with just a lifetime pension being paid, then the commutation value is going to be pretty easy to determine. It's all the entire value of the fund. So, whether you need to go to seek that information out from an actuary or not, whether the trustee makes the assumption based on previous actuarial certificates, they can do that, or whether they just rely on the member statements. If they're in BGL or class, then certainly they can take that pathway if they want. But if there's multiple pensioners, right? So let's say that Malcolm's wife also had a compliant lifetime pension, then it's in the best interest, I think, to at least have a discussion with the actuaries to determine how much value of that reserve is attributable to Malcolm and how much is attributable to the spouse, to ensure that the allocation where there are multiple pensions is done on a fair and reasonable basis. And that's one of the things that the legislation or the regulations, I should say, talk about, is that where you are making an allocation from a reserve and there are multiple legacy pensions, or there is a legacy pension that's not going to be commuted and one that will be commuted, then you have to make any reserve allocation on a fair and reasonable basis. So you've got to have some substance to the approach that you take. Some people will just look at those member statements and say, we think that's fair and reasonable because this is how it's always been recorded. I have seen other circumstances where they have made allocation references to the fact that one spouse is younger than the other one, and so therefore more of the reserve is actually allocated to the younger spouse because they have a longer life expectancy, and so it doesn't necessarily mirror the account balances. Why doesn't it? Well, because the account balance just assumes earnings on a fair and reasonable basis on an ongoing annual basis, as you'd all well appreciate. So that's the way that that's one of the things that Malcolm has to consider there. But once Malcolm has fully commuted and once he has done that reserve allocation, then he can commence an account-based pension, and in this instance, he can do it for the full value of the reserve allocation. or he can take the money out of super, or he can leave it in accumulation. Now, again, this is the circumstances if Malcolm is the original recipient of the pension. If Malcolm has received a reversionary lifetime pension, then he can either look to start a death benefit account-based pension, so a death benefit income stream, or take the money out, but he cannot roll that money over or back into the superannuation system. So, you know, there's quite a number of things to factor into that discussion. So where I want to sort of spend a bit of time just to, as we finish off over the next 10 minutes, the session, is talking about how these rules apply with regards to other reserves, but also these other non-standard defined benefit income streams. Because, as I said before, flexi pensions are not subject to the commutation rules. So they already have their own existing rules that provide a commutation value. However, the reserve allocation rules means that we can commute a flexi pension in accordance with the regulation. So you might have $1 million and you might be paying an income, let's say the income's $100,000. You then have to apply a CIS factor to determine what the commutable value of that pension is, right? And let's say based on the individual's age, that CIS factor is 6, right? And it's going to be something like 6, 7, 8, 9, 10. It's going to be a low number like that. So you then take the income, $100,000, you multiply it by that CIS factor, 6. It means the commutable value is $600,000. So they can roll back out of that pension $600,000 under the existing commutation rules. That other $400,000 is effectively forfeited to the reserve. Under these new regs, we can now allocate that $400,000, which previously we had to do on a fair and reasonable basis, you know, representing less than 5% across all members of the fund, or it would be counted towards our concessional cap. Now we can allocate that full $400,000 to the pension recipient without any cap considerations. However, one of the things to be mindful of is when we do an allocation from a reserve from a lifetime pension point of view, we are allocating based on the tax-free and taxable components that existed within the pension account. So if it was 50-50, then the allocation would be 50-50. If we are allocating it from a flexi pension, then that 600,000 would be 50-50, but the 400,000 would be 100% taxable component. So it has some estate planning ramifications there. Similarly, if we have a life expectancy pension, so if we think about the industry, the majority were lifetime pensions, second number would have been fixed term pensions, life expectancy, and then the third would have been these flexi pensions. So there would be a reasonable cohort of funds out there that have fixed term pensions that have ceased. That money is sitting in a reserve. That money can be allocated to the original pensioner cap-free under these new requirements. Now, the componentry will be 100% taxable component, but it can be allocated cap-free to that individual. Now, one of the key things about the regulations that were introduced is that many people, and it might be under the flexi pensions, it might be under the fixed term pension, many people might have said, right, well, this pension ceased 3 years ago, 4 years ago, 5 years ago, 2 years ago, it doesn't matter. When that pension ceased, we started allocating money to other members of the fund, right? And so we started to allocate to everybody on a fair and reasonable basis, representing less than 5% so that nothing was captured against the concessional cap. The way that the regulations have been written is we don't look back before the 7th of December. So any allocations made before the 7th of December effectively don't exist for the purposes of these new regulations. So it means if we've got that reserve and the original pension recipient is still alive, we can now allocate 100% of that to that original pension recipient. If we make an allocation to anybody else, we then tarnish that reserve, and it's a standard reserve, and all allocations are then subject to the standard 5% rule, or being measured against the non-concessional cap. And here's the kicker of that is when you look at tarnishing and measuring it against the non-concessional cap. And then you look at other reserves, such as self-insurance, anti-detriment investment smoothing. They were previously linked to this whole concept of less than 5% and measured against a concessional cap. And if you did that, there'd be no, so less than 5% and fair and reasonable to all members, then it wouldn't be counted towards the concessional cap. Now, less than 5% to all members, not measured against any cap, but more than 5% and allocated as you please, measured against the non-concessional cap. So what that means is that for any individual under the age of 75 who has a total superannuation balance of less than currently 1.9 million, but next year $2 million, right? They can allocate $360,000 and have it count against their non-concessional cap. It's not a non-concessional contribution because it's 100% taxable component from a reserve allocation, but it will count towards their non-concessional cap. So this measure is massive in allowing people to unwind these old legacy reserves. So not just legacy pensions and reserves, but legacy reserves that were set up for other purposes, because we can now push as much money out as we please. Because the other thing we know about non-concessional contributions is if you exceed the cap, then the excess over and above that cap is subject to a calculation of associated earnings. You have to rip out the excess and then you just pay marginal tax on the associated earnings less a 15% rebate. So the worst case scenario of allocating all these monies from a reserve to somebody that wasn't the original pensioner is they may be liable for tax on the associated earnings. But what it gives us is a great capacity, and particularly when the member has died. So when the original member has died and the pension wasn't reversionary, is we're not restricted now in siphoning that money out over a short period of time. We can bring other members into the fund. We can allocate up to non-concessional caps, subject to what other strategies are doing, and we can unwind those reserves in real short, rapid time to be able to then move and operate easily moving forward. So, you know, there's a lot of positives in regards to the introduction of these measures moving forward. So what I wanted to just briefly finish with you on is what we do, right? So at Smarter SMSF, obviously, as you know and appreciate, I do a lot of education in this space. And so my bread and butter is sitting here doing webinars on a weekly basis. But also what we do is provision of document support for advisors, accountants, trustees, administrators, whoever. And what we spent a lot of time once these regulations came in was we spent a lot of time creating effectively a document pack and a legacy pension hub to enable people to be able to commute these pensions. So what we're saying is that if you've got questions, if you've got clients and you want to go down this path, then certainly reach out to us. We can help you out with regards to that. Obviously, if you're talking with your actuary, that's great. But if you just need support with the documentation, then by all means, come and have a chat to us and we can help you out there. We can also provide trust deed upgrades if people go down that path. As I said, for the clients that I've been dealing with, it's probably sitting at about a 80-20% at the moment, like 20% are amending the deed, 80% aren't amending the deed because there's sufficient enough clauses within the original deed. So to summarize and wrap up for the day, 5 years to commute your legacy pensions. Importantly, no time limit on reserve allocations, right? So it's just the stopping of the pension that has 5 years and has that 5-year amnesty attached to it. Asset test exemption, you can act now, but ourselves and other providers in this space are saying, don't act until we've got that certainty, if you can hold off that little bit longer. So there's no pressing need from the client's health point of view. But as I said, I think that's going to be early September with regards to that. There will be sacrifices, whatever you do. So you either sacrifice the asset test exemption, you might sacrifice the exempt current pension income deduction, but you might reduce things like the PAYG withholding requirements and other admin, but you're going to get access to capital. And for a lot of clients, that's going to be a significant benefit in regards to a lot of these aging clients. So understand all the consequences attached with it all, and then I guess ultimately record it correctly and appropriately from a fund audit point of view. But we're seeing a lot of activity in this space, and I expect that we'll continue to see a bit more as the asset test exemption stuff comes through, but also as people sort of complete their the financials to 2025 and start getting a real recognition of what their balances are. So look, that's it. Thank you for attending today's session. Next webinar, I sort of last time I spoke about doing Div 296 and revisiting Div 296. Because Parliament doesn't sit until the 22nd of July, I thought that it's probably not appropriate to do Div 296 until we maybe have seen some legislation. So we're going to do trusteeship in the next session and talk a lot about the ins and outs. So enduring powers of attorney, appointing and removing death benefits, all those sorts of things, and how that impacts trusteeship. And then I'll look at Div 296 in August. But so we'll focus the August and September one around where we're sitting legislatively. So thank you all for attending today. As always, you'll receive a copy of the presentation. So SuperGuardian will send that out with your CPD. But again, thanks for attending. I look forward to catching up with you all in July. Have a great rest of the financial year. It's getting towards the end now, and enjoy the rest of your day. Thanks for attending. Bye for now.